You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Realize that there's a lot of managed money out there that automatically is set up to start selling stocks and commodities for fear of a recession when the yield curve inverts.
I'm Bill Powers. This is Mining Stock Education. I'm speaking today with my friend Chris Temple from NationalInvestor.com. He is an economic and political commentator, also writes a newsletter that I'd encourage you to check out at his website. I'll link to his website and Twitter connection in the show notes below. Chris, welcome back onto the program. And it is turbulent times. You know, I don't remember the late 70s, but I'm sure you do. I know you've talked in the past where what you're expecting we'll experience now is not the late 70s, but because of the last 2 weeks, do you think it might mirror the late 70s, at least in part?
I'll tell you what, in the recent few months and even weeks, Bill, it sure seems like we're going in that direction. The biggest similarity, frankly, in my view, is that Fed Chairman Jerome Powell is repeating in spades the policy mistake that Arthur Burns did in the 1970s. And that's what kicked off several years worth of double-digit inflation back then. His excuse for cheapening the dollar and having interest rates too low and so forth was that he was trying to lessen the shock on the economy from the Arab oil embargo. What he did instead was he enabled higher prices. Because look, when you think about it, with that embargo, we were not going to get that oil anytime soon, no matter what the Fed did, right? So all that Arthur Burns managed to accomplish was to cheapen the dollar and drive everything that's denominated in dollars, including oil, higher than it would have gone otherwise. And the Federal Reserve under Jerome Powell has done exactly the same thing. They had to lessen the sting from the pandemic. And so 30% approximately of all the dollars ever created have come out in the last 2 years. And that's really what kicked off all of these price rises. Recently, they've been exacerbated by Russia's invasion of Ukraine, no question. But that wasn't the cause of it all. Jerome Powell was the cause of it all, even if Sleepy Joe yesterday and some other people want to tell us now that all these price rises are all Vladimir Putin's fault, which is nonsense. So that's what we're getting. And so, yes, I wouldn't have said this 6 months or a year ago, but yes, we are getting back to the 1970s. And where it's going to really get ugly besides the price rises is when those price increases crater the economy, but cratering the economy won't make the inflation go away right away. And that's where we're going to get our stagflation.
Chris, growing up as a boy, I would visit my grandfather in Southwest Michigan. He had a business in Chicago, then retired to Southwest Michigan. He built that home in the late 70s. So I remember vividly, he has a gas tank in the ground, and then he has his own pump. So I always remember that as a boy, and my grandfather would explain to me the gas shortages and so forth. And that's why he put this in the ground out in the country. So I'm bringing up oil in this context. Oil is like I think a 125 a barrel or something like that right now. I mean, what does this signify in terms of a recession? And should we expect high prices? Because isn't high oil prices usually coinciding with the war cycle as well?
Well, they can. But again, the proximate cause of the inflation in oil and everything else has been the Federal Reserve. The Federal Reserve in the past, when it allowed these increases in oil and everything else for that matter to get too far out of hand, they belatedly react. They end up overreacting. And that overreaction of raising interest rates and tightening monetary policy causes a recession. Now, what's interesting this time, and we're going to learn tomorrow, Thursday, you and I are recording this on Wednesday, tomorrow, we're very likely to get yet another blowout number, yet another new 40-year high year over year in CPI. It could exceed 8%. Next year, the talk already is that we're going to be in the double digits because that will fully reflect the spike in the oil price. Yet at this point, the Federal Reserve, which I would have said and did say before the Ukrainian invasion, Russia's invasion of Ukraine, that the Fed might be a little bit tighter on things than maybe some of us were thinking. They now have an excuse not to do it still. So we'll get a 1/4 point rate hike a week from today, Wednesday, next Wednesday, and we'll get successive 25 basis point rate hikes. Maybe later on, if things settle down and the Fed is still playing catch up, they'll throw in a 50. But they're still going to be way, way behind the curve. And when you think about it, even as the Fed begins to act, real interest rates are becoming ever more negative as the inflation numbers go up and they don't do anything. So, it may not be, Bill, the Fed directly via rate hikes that causes a downturn in the economy, but it will be the unsustainability of these price increases and everything that we're seeing that at some point must cause consumers and businesses to pull their horns in.
What are you seeing in the yield curve? What is that indicating to you?
Well, I'll tell you what's fascinating to me right now. And, we're all, every time you turn around, the cycle doesn't repeat like it did in the past. The business cycle has been totally bastardized by the Fed. It's nothing like it used to be. So we have to come up with a new playbook all the time. And in the past, what would usually happen, there was this old saying when the Fed would get finally and belatedly on one of these tightening gambits, the old saying was 2 steps and a stumble, that the first couple of rate hikes by the Fed may not do much harm, but then you get 3 and 4 and more, and then you do see a stumble in the markets and in the economy. And it's astonishing to contemplate right now, because the Fed has so skewed things to begin with, that the yield curve even now is not real. Interest rate levels are not real. The idea that we're still below 2% when inflation on a 10-year Treasury note, when inflation is 8, is lunacy. But it could be just one single rate hike next week that inverts the yield curve. Now, we'll have to take that with a grain of salt, Bill, because again, the Fed has got its heavy thumb on the scale, and a lot of these numbers just aren't real in the real world. But one of the things all of us as investors, and I have to throw this in, especially if you're big in a lot of the commodity trades, realize that there's a lot of managed money out there that automatically is set up to start selling stocks and commodities for fear of a recession when the yield curve inverts. It's not going to be people as much as you might think that make this decision. So we all have heard about algorithms on Wall Street and about how so many mutual funds, so many hedge funds, so many directional traders, they use these algorithms with these preconceived notions. Well, a preconceived notion being that if the yield curve does invert, no matter what inflation still is, and this is part of the idiocy and really the abnormalities of the time that we're in. If the Fed raises rates 1/4 point or more as time goes on, and yet because of the lingering concerns over foreign issues in Ukraine, and God forbid China decides that, hey, we can do this too, they'll take Taiwan, and you get a rush to safety, and that pushes down the long end to invert the yield curve, automatically you're going to see oil sold. You're going to see gold sold. You're going to see nickel, which has screamed higher this week. A lot of these things will get hit. Now, long term, these are all still great places to be.
So the best buying opportunity is still ahead of us, potentially, you're saying, for commodities investors.
It could be. Look, I've thankfully, I've got a pretty heavy commodity exposure in many different areas among my recommendations. At the same time, we've had a little bit of a ballast, if you will, from a few of the inverse ETFs. So they've all been working pretty nicely lately, and we're going forward with our portfolio, which is nice during times like this. But yeah, I think that even though you can be buying good individual stories and hanging on to them, regardless of what happens, if you have traded, especially into any leverage plays, into a lot of the commodity complex, you got to have a foot toward the exit door right now. You're going to see in the next several days, you're going to have 2 signals as to what the Fed might do. The CPI number out tomorrow, Thursday, and next week's Fed meeting. The Fed, we'll see how tough they actually decide to talk. We'll see what the so-called dot plot is. I think deep down, they still are convincing themselves, or trying to, that a lot of this stuff will just run into a wall, and that of its own accord, or of their own accord, I guess I should say, prices for a lot of things will inevitably come down as the economy bogs down, and these soaring commodity prices will do the job for the Fed without them having to raise interest rates as much. I think that's what they want. I think that's what is in the back of their mind. But here again, they sowed, they sowed the wind themselves, and they're reaping the whirlwind. We're all getting it, and contrary to this utter nonsense out of the president's mouth and others, it has been the Fed, number one, and this administration, number two, that with oil specifically and energy specifically have made a bad situation much, much worse. I said a long time ago, as you know, that we were on a course for a new energy crisis, which is only just beginning. Even still, we're going to be paying Canadian, if not European, prices for gasoline and eventually for utilities in this country. And we're not going to be a whole lot farther toward this green economy of everybody driving EVs and using solar panels and stuff like that, because the present administration has greatly harmed our own domestic and regional ability to do these things. They killed Twin Metals in Minnesota. They've thrown new monkey wrenches into Polymet, the Resolution Copper Mine, and others in Arizona.
Trilogy Metals recently too, Chris. Trilogy Metals in Alaska. They said, wait a second, we gave you your permit. Let us look at this again, which is totally unfair.
Yeah, and the president's interior secretary can't sleep at night because she hasn't yet shut down Energy Fuels' White Mesa mill in Utah, which is the only mill in this country that can process conventional uranium ores and is now processing, at least part of the way, a rare earth element material, both of which we desperately need, all of which the president claimed he wants to start to reinvigorate again is the answer for us, being where we don't belong. That's a whole different story in Ukraine and Europe, and causing problems for the whole damn world where energy is concerned. So we'll see. But what I was painting as a bad picture of a new energy crisis just has been squared by events of the last few weeks.
Well, Chris, I'm going to be participating in a conference that you have coming up in Chicago, Friday and Saturday, May 6th and 7th. You've entitled it North American Green Energy Themes, Investing in the Great Stagflation. Now, you came up with that name before the last 2 weeks. Is that still the title and still the focus in light of recent events?
Ever more so, Bill, that's right. I'll be really brief here. This is a rebranding of the long-running Chicago Resource Expo. My good friend of a lot of years, Rich Redez, who used to be a retail broker, had it in his heart way back going to the late 1970s to be one of the first people to put together. I think it was him and Blanchard, really, Jim Blanchard, the late Jim Blanchard, who put together resource and even precious metal specific symposiums, and went on for a long time. Like all of us now, we're trying to get back more into the normal routine of in-person conferences and so forth. And it was a really good time to rebrand this. So not only are we going to have the macro discussions, you're going to be there, I'm happy to say, for that. So everybody out there in the audience, register, come and see Bill and I and lots of other people. So we'll have the macro discussion, understanding how to invest across the board in times like this. Precious metals, base metals, green energy, a lot of story stocks. I'm going to have a couple exciting biotech and medical technology companies there as well. And yes, the big thing that we've added theme-wise is this whole area of green energy, because there is not a bigger issue today that intersects both public policy and investing than does, what we use as a catch-all term, green energy. You can call it battery metals, critical mineral supply chains, whatever you want to paint it with. And again, aside from labor costs, which are going to continue to rise, that's one of the big changes compared to the last 40 years of disinflation, an era which is now over. Besides labor costs, the biggest input is energy costs. into inflation. And it's, we're only seeing the beginning of this, folks. I'm sorry to say. And this was already the process, the road we were going down before Russia invaded Ukraine. And this has just made things, worse and has revealed even more the vulnerability that we uniquely have. And in one sense, even though we've hit this hornet's nest over there with a baseball bat for years to lead to where we're at today, we still are somewhat insulated in this country. You look at natural gas, especially, and gosh, you look at the prices are paying in Asia and Europe, it's through the roof. And we're in still relatively good shape here, even exporting some gas, and we'll be exporting even more of it. A couple of my recommendations are based on that theme. But, it's a matter of time before, especially if the Fed doesn't act to try and put at least some of this inflation toothpaste back in the tube, those prices are going to be dragged up to be more like what they are elsewhere also. So lots of moving parts. We're getting into stagflation. It's going to be far more extreme, as I said earlier, than what I would have expected.
So hyper stagflation. We just need to change that in the title. The Great Hyper Stagflation.
I don't know about hyper, and the reason for that is that there's another old saw that says, that asks the question, what happens when an irresistible force meets an immovable object? The irresistible force is that so many commodities have such fundamentally, screamingly bullish setups because supplies are short, demand has come back. A lot of these different things. When we could go into them individually and take all the rest of this day to do that. But the immovable object is that at some point, Joe Sixpack and Sally Soccer Mom or the business owner say enough. One quick anecdote on this.
Chris, I'm already hearing that with gas prices here. I can't tell you how many times today people said, I don't want to drive anymore. $4.50 a gallon where I'm at.
No, the point comes where you can always raise prices as far as the market will bear. The question is, how much more will the market bear? I did an interview on a radio show a few weeks ago, and one of the people that called in is a farmer from southeastern Wisconsin. And he plant, forget exactly what it was, but it's grain. He's a grain farmer, and all farmers, by and large, the routine at this time of year is that you've got your nut for the year that you've got to account for, all of your upfront costs, and you have different ways you finance it and so forth. He told us, myself and Drew Mariani, the show host, he told us that a year ago, his upfront costs for 2021 were in the neighborhood of $225,000. Do you know what his upfront costs are for this year, 1 year later? $390,000.
Yeah.
Okay.
And that's because of fertilizer primarily, right? And grain.
It is. Yeah. It is. I mean, one of the consequences of all of this, and again, Europe is already feeling this far more acutely than we are, but we will feel it. There will start to be more consequences. Fertilizer costs have already in Europe resulted in a lot of mid-size and smaller farmers just closing their doors. You can't pass on these kind of costs that are this extreme. So you've already got food shortages. We see in our country, a little bit of that here and there, but in relative terms, so far at least, not to the extent that they have it overseas, but there is a risk of that happening. So, I mean, this is something, and again, it saddens me that whether you consider yourself a Democrat or Republican, a liberal or conservative, the majority of the people in this country are so shallow in their thinking and so uninformed and misinformed. If Fox News told you as a conservative that the moon is made out of Swiss cheese, you'll believe it. And you'll throw names at anybody that argues with that. Likewise, if you're a Democrat, you watch MSNBC or CNN, and they tell you the moon is made out of Swiss cheese. Well, if you don't believe that, well, you're a Trumper and a neo-Nazi and you're whatever. Okay. The fact is that we have a monetary system in this country that needs to be replaced. It has caused all of these problems that we have. Vladimir Putin is not the chairman of the Federal Reserve, nor is he the president of the United States that is shutting things down that we need to become energy independent. Now, there are some glimmers in just the last few days that maybe some of the more sane people around the president are going to, seize him back from the loony left, and maybe we will see to our own domestic needs. But I don't know. Not what are we going to do? We're going to replace Vladimir Putin's oil with that from Nicolas Maduro and Venezuela and from Iran. Allegedly, there's a story that the president may actually travel physically to Saudi Arabia to beg and plead and scrape for more oil because they won't take his phone calls over there. I mean, this is a sad state of affairs that we're in, and it's going to affect us all. We're gonna learn again, Bill, as people did during the Depression. And I'm not necessarily forecasting a multi-year environment like that, at least at this point. But we're going to learn to distinguish between needs and wants. And just like the folks that you talk with, how many times you're going to take your boat out? I saw a thing at a marina in California where gas was just a whisker under $10 a gallon. So you better have a lot of scratch if you want to get out and play in the boat this weekend.
Oh, that's a great point, Chris. Well, there's opportunities and there's risks. You've heard us talk through a number of them here, but if you want to meet me and Chris in person, we'll be at the conference May 6th and 7th in Chicago, and I will link to that in the show notes below, as well as Chris's website and subscription service. Chris, thanks for coming on the show today and sharing your insights.
Hey, anytime, Bill. I look forward to seeing you in person. Not too many weeks hence. We're down just under 2 months.
Absolutely.